Hello, welcome back, guys. We are taking a look at MercadoLibre in this video, which is a subscriber recommended company to take a look at. You will see that this is a pretty large company, 30,000 employees, and pretty high beta, meaning that it's moving quite a lot, a little bit volatile compared to the overall market. A 2007 IPO as well. It operates e-commerce platforms in Latin America. Okay, let's take a look at what the company is doing and the stock as well. And if you see the stock here in the chart, you will see that the 1 year high of the company has been near 2000, and right now it's down 53% of that high. Now, if we take a look at the, let's say, 3-year chart, you will see that the company has been having an absolute banger in terms of increasing its stock price, and then, it went down with the overall market. Pretty much a lot of the stocks are actually down right now, so this kind of 53% could happen without actually meaning much about the company and how they are doing financially. But we're going to examine that. And so if we take a look at the PE ratio, this already looks super high here. And if you notice, the previous years was actually relatively negative and very negative in 2020 over here. Now there are times where the PE ratio can be a little bit elevated but not tell the whole story. But if we take a look at the price to free cash flow ratio, this is also relatively elevated. And it's coming down a little bit, but it's still hovering at around 125 here, which is very high. Now, the outstanding shares of the company have been increasing slightly, 14% in about 5 years. That's a little bit of an increase, but not something that would 100% deter me from buying the stock. Although it's something that I would definitely take into account because there's a little bit of a dilution going on here. Now, the free cash flow to total liabilities is very high as well. This means that we need about 24 years of last year's free cash flow to pay back all the total liabilities of the company, and it's a measure of how solvent the company is. So this company may have a lot of debt. We can actually examine that in a little bit more detail later. The 5-year revenue growth has been increasing, which is nice to see, from about 1 billion to 7 billion. So the company has been selling well. This is a good first step. 5-year net income growth increasing as well, but notice that it was positive, then went very negative, and then it's actually jumped up higher, and it's sitting at pretty much marginal gain here. Now, the 5-year free cash flow growth has been also a little bit all over the place, and right now it's sitting at about 355 million. And the total equity growth as well. The company has been growing its equity a little bit. Remember that they have been selling some shares too to achieve that. Debt to equity ratio is also a little elevated, as you will see here, and typically you want something that is less than 2, as you can see in the little helper here. And return on equity is very great about this company, 21.9%. Maybe that has to do with the debt as well. And if they have a lot of debt and they are doing 22%, that may actually not be that great. Okay, the net income margin of the company though is very low and actually concerning here. 1% for the most part, 1.1 is what we are having here. Okay, let's take a little bit of a closer look at the financial statements next. What's happening actually with this company? Again, we know that they have been increasing their revenue, which is nice to see. But if we take a look at the net income, you will notice many negative years and negative growth here going on, and the company had 13 million in net income back in 2017, and now after 5 years they have just a little bit more, while in between they have been losing money. Okay, so marginally profitable, it looks like what they are right now. Interesting. And if we take a little bit of a closer look at the total liabilities of the company, we're noticing that they have 8.5 billion in total liabilities, while their total equity is extracted from their total assets to give us from the total liabilities in order to give us 1.5 billion in terms of total equity for the company. So quite a few total liabilities here as well, 8.5 billion. And remember when we took a look at how many years of free cash flow it would need to pay back all the total liabilities. If we take a look at the free cash flow here is 355 million. And when you compare that to the 8 billion, this is where you're getting about 24 years of free cash flow required to pay back all the total liabilities. The company has a lot of total liabilities compared to the free cash flow that it has. Now they do have some increasing cash at the end of this period, which is nice to see, of course. And also the company's operating activities is positive, which is of course nice, But net income, remember, has been a little bit all over the place. So things that are affecting that is depreciation, amortization a lot, and some other non-cash items that typically they are like one-offs. And cash from investing activities minus 1.5 billion here. So the company has been, for the most part, selling some maturities, as I'm seeing here, and also buying back some new ones. So kind of balancing themselves out here for the most part. And in terms of financings, these are all positive here, meaning that the company is getting debt, as you'll see here. 9.5 billions of debt is what we talked about earlier. The company is getting a lot of debt here. It's a company that typically would take some debt here. This kind of company, an e-commerce company, that would make some sense. But they seem to be getting quite some of it. And last year they took 2 billion, now almost 10 over here. Interesting. A lot of leverage being used, it looks like. Okay, and free cash flow from 194 million to 355 million. It would be worthwhile to take a look at why they are taking that much debt, taking on that much debt. I can probably take a little bit of a closer look at that, but first let's take a look at the stock evaluation tool and see how much it makes sense to pay for the company right now. Alright, so let's use our revenue growth projection, historical averages here to do our projections. And you can find the handy table here. Of course, we cannot go that high for sure. We'll go something, let's just say something like 17, 19, and 21, which is still pretty high actually. But the net income margins, look at this one, they are close to 0, 1% is what we examined earlier. It's very low. And so we will go with something like maybe 1, 2, and 3, which is like marginal. And 3 is actually quite some compared to what the company is doing. Even 2 is quite some. Free cash flow margin. Now this free cash flow margin is again all over the place because there is very little net income that the company actually generates, and so the free cash flow margin is basically manufactured because of like depreciation and amortization and back these non-cash items that we examined earlier, and so it doesn't really have much net income to convert free cash flow to. So typically we're going to be using something like 70, 80, and 90%, but it's not affecting our projections so much because the net income margins are very low to begin with. And so this value is about how much of the net income gets converted to free cash flow margin, to free cash flow. And so if we don't have enough of that, then this kind of value doesn't really affect much. But since we don't have too much here, even if we use higher or lower values, again, it won't really affect our projections too much. In terms of free cash flow, that is. And 13% is what we want to use in our annual returns. And if we hit calculate, we are getting that our current price is extremely elevated compared to even our high estimate here. And that's again because of the company not really making money. They are like marginally profitable in some situations, and in other situations they are not making money at all. Like you will see here, 83 million. So the company made it just 83 million in terms of net income in fiscal year 2021. And if you go back to the stock analysis chart, you will notice that the company has a $46 billion market cap. So insanely high market cap, just making 83 million of profit. So that's something that's not good to see, and it's something that you would expect just by looking at these initial values here is exactly what you are getting out of our stock evaluator, out of our stock evaluation tool. And again, remember also that the company had quite a large debt position as well, debt to equity ratio of 1.7%, although the current ratio is a little bit better. The total liabilities compared to the free cash flow quite substantial here, and the company seems to be getting more and more debt. That's something that I don't like to see. And you can kind of take a look at the debt as well here. From 368 million, it has risen to 3.4 billion here as years progress. So yeah, this is not necessarily a bad thing. Again, it really depends on how the company is using its leverage. But the thing that concerns me a lot when I'm seeing this kind of debt is that the company doesn't have that much in terms of free cash flow and net income. And so when companies start amassing debt without having a lot of free cash flow and net income to actually used as sort of like a collateral for this kind of data they're getting, then I'm getting a little bit concerned because now we're having a very, very leveraged company. And, if things go astray and they don't continue with what they have been doing in the previous year, really, then we can go back to non-profitable years like these ones. And then how do we actually pay back our debt is a question. Like they will have to either issue more shares or get more debt. And because they haven't been issuing too many shares already, maybe that would give them an opportunity to do so, especially at this current price. And so I would like to avoid that. And this is why I wouldn't be looking at a company like MercadoLibre for my portfolio. I'm not even close to buying this one. I would probably completely avoid and maybe wait for an insane crash of this one in order to buy, or an insane increase in what they are doing in terms of profit or in cash flow. Otherwise, right now, for me, this would be a pass. But thanks a lot for suggesting this one. Interesting one to examine for sure. Tell me, guys, what you think about Mercado Libre. Leave a comment below. And if you are not a subscriber, remember to become one and leave a like at the video as well, because that really helps. And if you haven't watched that one already, take a look at the video that I made earlier. And this one is about Smith & Wesson, a very well-known brand that could be a potentially nice purchase in addition to a portfolio as well. And thank you for watching this one again. I'll see you in the next one. Bye-bye.